So let's say you're an experienced options trader and you're looking for new ways to profit from the market. Okay, so you've been trading for a while. You've had some success at it and you're looking to improve your performance outside of just the basic plays of calls and puts. So you did some research, you found about put credit spreads, and now you found out they were a pretty good way to profit from a bullish market. And you also like the fact that they actually have defined risk, and that's important to you as a trader. Using put credit spreads and other vertical spread choices, I think, is a great addition to your trading toolbox. And in this video, we're going to explore how you can get started. So what is a put credit spread? Essentially what you're doing is you're selling an out of the money put option and buying a further out of the money put option at the same time. So we would do this when we expect the underlying asset to stay relatively stable, like sideways, or increase in price a little bit. Put credit spreads, they offer limited downside risk, plus they provide the potential for a pretty decent return. The risk is limited by the width of the spread minus the credit, and we're going to talk about that in a second. Now, these could be the right strategy for you if you are looking for neutral to bullish positions to find risk. So this type of spread can be really beneficial when the volatility is high because it does allow you to take advantage of higher priced options. And when you compare it to other strategies, these typically perform better in higher volatility markets. So when we're talking about this, let's talk about weekly or monthly options. Which one should you use? All depends on your time frame, your experience, and what you're looking to achieve with the trade. You can use either or, but we recommend always starting with monthlies, and monthlies that are liquid, but they also have about 20 to 40 days left until expiration. When you become more comfortable with this strategy, go into weekly contracts. If you're looking for a quick trade, then weeklies are probably the better one for you, but you need to be comfortable with the underlying assets movement. That gets exaggerated as the weekly options are more sensitive to price changes. Okay, the effects of time decay increase as you get closer to expiration, so you got to be mindful of that as well. So really deciding which one to use comes down to your trading style and what you want to achieve. So how do we set them up? So we're going to sell a put option at one strike price, at the same time buy a put option at a lower strike price. The maximum profit that we're going to make is whatever price, so premium, that we collect when we put the trade on. So the goal for this is for the underlying asset to not fall below the strike price of the option that we sold. So we make money on this trade as long as that stock price or the ETF price stays above the strike price of the option that we sold to open the trade. So if I sold a put credit spread for 60 cents, the maximum profit I can make is $60 per spread. So our criteria when we're choosing the options, we want to sell the put option contract that has a 65% chance of closing out of the money. We want to buy a put option further out of the money that allows us to put on the trade for 30 to 40% of the width of the strike. The examples coming up are going to help you out. So using QQQ, let's say we determine we want to place a neutral or bullish position using a put credit spread. So we go with the October 23rd weekly options. They have 20 days left to expire. We go to the 265 out of the money put option, has a 64% chance of closing out of the money. We sell that option. We will also buy the 263 put at the same time. And now we have a risk-defined trade. So there's a $2 difference between those two strike prices, 265 and 263, which means we want to collect between 60 cents and 80 cents because that's going to allow us to collect between 30 to 40% of that $2 difference between those strikes. Selling the spread to open for 60 cents allows us to collect $60. That 60 is the most that we can make on this trade. The risks, these potential gains aren't bad, but they do come with risks. The maximum risk is the difference between the option strike price minus the credit that you received for placing the trade. Now, important to remember that credit spreads offer fully defined risk, right? It's not like the basic call and put trades. So this means that if the market moves drastically against you, your loss is capped at a maximum risk. So again, using the QQQ, our max risk on the trade is $1.40 a share or $140 per spread. We get that by calculating the $2 difference between the strike prices of the options, subtract the 60 cents that we collected to open the trade. So keep in mind always that when we talk about these numbers, each options contract contains 100 shares of stock. So that $1.40 per share, you have to multiply that by 100. But as always, you have to analyze the market conditions before you get into a credit spread. You want to minimize any losses. In addition, properly managing your position by adjusting or closing out as necessary, that can help you mitigate risk. So how do we profit? When we sell a put credit spread, we make money if the stock goes up, down, and sideways, but only if the stock stays above the strike price of the option that we sold. Time decay adds up. With every day that passes, the options get cheaper. Decreasing volatility also allows us to make money. So essentially, our goal is for this options to get as cheap as they can. So we close the position at a cheaper price than we sold to open it. Using the QQQ, the profit potential of this trade is limited to the credit received, remember this, which is only $60. Break even on the trade, hey, things aren't going to go as planned, right? We're going to have losing trades. We're going to have break-even trades. Our break-even point is at 265 put strike of the option that we sold. We're going to subtract the 60 cents that we collected to open the trade. So we need that stock to stay above 264.40 to make a profit. So at NetPicks, our preferred approach is to not hold until expiration. We can only book the full potential profits if we hold, but we like to be a bit more conservative. So when we can keep 50 to 75% of the max profit on the trade, we'll close the position. So for example, if we collect 60 cents when we open the trade, we want to close the trade when we can buy it back for between 15 cents and 30 cents. And this is going to allow us to bank 50 to 75% of that 60 cents that we collected. So in summary, put credit spreads offer fully defined risk, can be attractive for your gains. The max risk is the difference between the option strike price minus the credit received for placing the trade. Credit spreads can be profitable if the stock goes up, down, or sideways, but only if that stock stays above the strike price. Properly managing the position by adjusting or closing out as we need to can help mitigate our risk. And we prefer to not hold until expiration, and we will look to close a trade when we can buy it back for between 50 and 75% of the max profit. Hope you found this interesting. If you're interested in learning more about credit spreads and other option strategies, you can download our free 8-minute options guide today. Totally free. It's a PDF. You can download it. Make sure you hit like and subscribe. We'll talk to you soon.